My name is Sharon Kyoko at University of Washington. So David Wessel brought us together, John Mikesell and I. John Mikesell is actually my sales tax professor at Indiana University. For those of you who know me, sales tax is not my daily bread. I'm usually a municipal bond person. But I thought this would be an interesting project, and when I started talking to Mikesell, I said, let's think about, the sharing economy, this new economy, thinking about, Airbnb and Uber and Lyft and how the retail sales tax is going to change in this new economy, hence the title. And he said, you're assuming the old economy works pretty fine. So you'll see we talk about the old economy and the new economy in the paper. A couple of quick comments. One, please read the paper. There's more detail in the paper than I'm able to present in the next 15 minutes. Any errors in this presentation are mine and mine alone. If most of you know John is an expert in this topic. I don't think I can do the topic much justice compared to John, but he was unable to join us today, so I'm doing this presentation. So again, any errors are mine and mine alone. So if anything correct is John, anything wrong is me. If you know the retail sales tax, thinking about the history of the retail sales tax, it was born out of the Great Depression, out of desperation. The graphic there shows the retail sales tax between 1902 and 1950. And you can see the property tax was the largest state tax source, and that fell by 11.4% between 1927 and 1932, and then again another 16.8% from 1932 to 1934. And you can see from the graphic there, by the time we got to 1935, the sales tax had become the largest source of revenue for state governments, and the property tax was far below the retail sales tax. The innovators in this space were Mississippi. Mississippi converted its gross receipts tax to a retail sales tax in 1932, and West Virginia adopted a freestanding retail sales tax in 1933. And it's important to understand that they are innovators in this space because, as John says it, if you can make it there, you can make it anywhere. It produced revenue in even the most poorest states, and 10 more states adopted a retail sales tax by 1933. So it's important for us to understand the retail sales tax in the current economy. It's important to understand some of its flaws and how those flaws will impact how we change the retail sales tax moving forward. Historically, the tax has been a tax on goods and not services. That's the way the legislation was written. States copied legislation from each other, and changes have been slow. The political forces have limited the expansion of the retail sales tax, particularly to services. And as you know from a number of studies, consumption of services has grown faster than the consumption of actual goods. So we're actually seeing a shrinking in the taxable base for the retail sales tax. And the retail sales tax has also focused on finished products and exempted inventory purchases, but paid less attention to exempting other inputs that are used in the production process. So there's still tax pyramiding happening with the retail sales tax. And for those of you familiar with the value-added tax is able to address that shortcoming much better than the retail sales tax. And then another historical feature, this I did not know, is to avoid being responsible for the increase in prices, what the states did with the retail sales tax is they did not embed the retail sales tax into the price of the product. So your price of the product does not include the retail sales tax. It's always included in the receipts for the purposes of transparency. Now here's some important stuff, really important stuff. John gave me some really detailed notes here. A couple of good things to remember here. So the graph here, you can see the solid line is the retail sales tax, and that's as a share of the state's revenues. And the dotted line is going to be the income tax, individual income tax. As a share of revenue, the retail sales tax exceeds the individual income tax, even though the individual income tax generates more revenue. Now, this is a feature of a number of things. I mean, when you do the percentages versus looking at the dollar amount, it will give you different numbers. But even though the individual income tax generates more revenue in aggregate for the states, the retail sales tax as a share is actually a much larger portion of it. That being said, the income tax has been growing faster relative to the retail sales tax. And one thing that we go into detail in the paper is that we show you that some of the data that comes from the Census Bureau, you have to make modifications to that data because the way the Census Bureau collects that data aggregates a lot of taxes that are not retail sales tax. So it may include some business and occupation taxes or gross receipts taxes into the retail sales tax data. So, in our discussion of new versus old, we thought of, let's think of it as endogenous versus exogenous. And endogenous is what we believe is within the control of state policymakers. And here we're thinking about exclusions from the taxable base, notably here of services, the exemptions, the types of exemptions that have been adopted by states over time, and we'll show you a table of that, mainly because of their nature. For example, food for at-home consumption, who the buyer may be. For example, if a university is purchasing items, it's exempt from the retail sales tax, and who the seller may be. And the classic example here is going to be Girl Scout cookies. And then there is concerns over overreach. So if you believe the retail sales tax is a tax on final consumption, a lot of services that are actually now taxable are those services that are primarily used by businesses and not those that are for final household consumption. So for example, your personal care services, for those of you who enjoy a manicure, pedicure, a haircut, those for the most part are not taxable, right? And those may generate a revenue, a good source, maybe a good source of revenue. So personal consumption services are not taxable, yet business type of consumption services are taxable. So to think about the exclusions, a quick summary here. Some states have expanded service coverage, but not broadly. So in 1971, 26 states excluded, and by 2018, only 3 exclude. You can see the largest changes have been in the selective category, so 17 stated selectively taxed services. Now we are up to 38. But those that generally tax services have only changed from 2 to 4. The problems again here, the services that are selectively taxed are minor classes, service classes that yield minimum revenue. The coverage of those services is most exclusively on businesses, and even selective coverage is difficult to add, given the example of Kentucky in 2018, where there was a veto over this taxation of services. Again, the second point here, changes in the consumption patterns. We're increasingly consuming services, and our share of consumption of goods is decreasing. The dashed line at the bottom there is looking at the typical base right now, and the dashed line at the very top there, sorry, the screen is blurring that a little bit, includes all consumption, including healthcare and education. And the solid line in the middle there is capturing what will be a typical base plus services, excluding healthcare and education. Now, between 1970 and 2016, the typical base, the line at the bottom, has declined 20% relative to what it was in 1970. What would be ideal here is to see if states can broaden the taxable base, and broadening that taxable base, even to move it to the typical base plus services, excluding healthcare and education, that would expand the base by 8%, which would generate significant amount of revenue. Exemptions, you know these exemptions a lot. Food for at-home consumption, clothing, prescription medication, gasoline, cigarettes, and the more popular sales tax holidays. Most notably, the food for at-home consumption right now, we exempt practically a vast majority of the states with a retail sales tax exempt food for at-home consumption, even when programs like the Earned Income Tax Credit have been proven to be an effective way to actually reduce the burden on low-income households. We could easily convert tax household consumption and provide tax credits to low-income households and improve or decrease the regressivity of the retail sales tax. Taxation on prescription drugs, the same idea here, is exempt in 44 states when earlier it was exempt in 26 states. So this is, I think, the more important chart. I've already shown you what the retail sales tax remains. The evidence shows us right now the taxable base has declined as a percent of personal income. In 1970, it was about 54.4%. Now it is at 37.3%. As a result, the statutory rates have had to increase substantially to yield the same amount in revenue. Another way of thinking about it, if you look at the table in the paper, the retail sales tax generated about, there were more than 25 states with a retail sales tax of more than 6% in 2016, and going back to 1970, there was only one state. Add on the local option sales tax, we are looking at sales tax rates at above 10%. All right. I'm quickly running out of time. Looking at exogenous, so the new economy. Internet and remote sales, we know we have the Supreme Court ruling that happened, the sharing economy, and if you are not familiar with zappers and phantomware, there's a short discussion in the paper on that. The ruling, South Dakota v. Wayfair, changed the physical presence rule. If you haven't had a chance to review the ruling, it is a very interesting, detailed discussion. But what the court noted is that the decision in Quill, which it overturned, it was arbitrary, formalistic distinction that is artificial not only at its edges, but in its entirety. The court was actually frustrated by the fact that large retailers could circumvent the retail sales tax when small retailers would not be able to circumvent that because they had physical presence, and the larger retailers. States can now legislate registration and collection requirements, how much revenue. There are different estimates out there, anything between 2% to about 9%. The court did warn against discrimination against undue burden upon interstate commerce. They particularly wanted to make sure the burden was not on small vendors, the burden was not extended retroactively, and reduce the compliance clause. Note that the Supreme Court decision also specifically addressed the state sales tax. It doesn't necessarily address the local sales tax, at least from my reading. It also doesn't address marketplace facilitators. So for example, if you buy from Amazon, you pay the retail sales tax. But if you buy from a retailer who's using Amazon as a platform, Amazon is not required to remit sales tax. So there's a difference. So you have to look at who is actually the retailer in this place. Will Congress act? I'm sure anybody who's working in state is hoping that Congress does not. Regarding the sharing economy, what we found here is that there is really a jumble of rules and a lot of challenges that we expect to come from different vendors, Airbnb, VRBO, Uber, Lyft, etc. The challenge here is that for some of these services, they are not taxed at the state level. So some taxi services are not taxed, so it'll be hard to tax Uber or Lyft if those services are not taxed. The other part is that a lot of these marketplace facilitators are arguing that they are just facilitators and not necessarily required to collect the tax itself. Finally, zappers and phantomware. It makes retail sales tax disappear. There are a couple of cases that have actually been argued and won in Washington. Essentially, you insert software into the into the machine at any restaurant, and you're able to make transactions disappear, including the inventory. There are concerns over essentially tax evasion here. Again, the paper goes into much more detail. I apologize, I have run way out of time. Happy to answer any questions you have. Thank you.
Hi, I'm Tracy Gordon from the Urban Institute. I've known Sharon and John Meixler for a while, and I can't resist telling a story, which is that John was on an advisory panel for a report that we put together on state fiscal capacity, which is basically taking a nationally representative tax rate and applying it to the base that could hypothetically exist in a state regardless of any policy choices the state makes about what it wants to tax or what it doesn't want to tax. So you don't get into this like, is marshmallow a food or whatever. And John was obviously there to comment on a whole range of issues, but especially on the sales tax. And he was pretty quiet during the call, and then I got an email where he said he had lots of comments and he disagreed with things that other people, well, I don't know if there were other people on our panel or people that on the research team, things that we were saying, but he said that he was disagreeing and shouting, no, 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 at the phone, but he couldn't figure out how to turn off mute. And so nobody could hear him. And I was thinking, oh, thank God you couldn't figure out how to turn off mute, because the idea of John Meixler yelling at me that we were doing it wrong in terms of counting the potentially taxable sales tax base sounded like a nightmare. So anyway, I'm very happy to have read this paper and learned quite a bit. So as Sharon mentioned, the sales tax is huge. It is the single largest tax revenue source for state and local governments combined, as this graph from one of our helpful backgrounders at the State and Local Finance Initiative says. But as Sharon mentioned, the income tax looms larger for states. So it depends sort of whether you're talking about the 45 states that have a sales tax or the 38 states that have both. But just in pure dollar numbers, states took in about $400 billion from the income tax last year compared to about $300 billion for sales taxes. On the other hand, of those 38 states, there are something like 11 states, I learned from your paper, where a sales tax is a bigger source of revenue for states than the income tax. And it was the largest source of state revenue for most of the modern period from about 1947 to 1997. So sales taxes are super important. And I would argue have even shaped the way we think about state and local finances and sort of what these governments raise and collect. So the sales tax is important, and it's disappearing, and this is a whole body of work that John in particular has done on the disappearing sales tax, or the way in which the base has been eroding over time. One issue with this figure is this is the implicit sales tax base, and I had a heck of a time figuring out what the implicit base was. I think it's like footnote 17 somewhere, and so putting that up front would be helpful. But obviously then, too, Sharon pointed out that when you have a smaller base, you need to have a higher rate to raise equivalent amounts of revenue, so this is almost a mechanical relationship, but has really important economic consequences given what we know about the importance of tax rates and deadweight loss. So basically, when you double the tax rate, you more than double the economic loss. You square it, yeah. So a lot of these problems are longstanding. Some of them are new. So as Sharon mentioned, services are an increasingly large share of the economy. So at the beginning of the national accounts in 1947, services were about 30% of transactions, goods were about 60%. I'm sorry, 40 and 60, and now it's about 70-30, 70% services and 30% goods. So if I pay someone to come and mow my lawn, I don't pay any sales tax on that transaction. If I go buy a lawnmower, then I am paying sales tax on that transaction. Obviously, that is an unequal, unlevel playing field. In addition to that, there are these sort of causes of self-inflicted damage. One comment is that that table that you showed with the E and the R and the colons and the semicolons would be much more effective as a figure. So you can see the number of states that had exemptions for certain types of purchases like food, clothing, and prescriptions going up over time. And then for things that we consider bads, that those exemptions are actually going away. And if anything, there are separate taxes on those types of consumption. And then we have the number, I think it's 17 states that have sales tax holidays. I was surprised to learn from your paper that actually many of these states have multiple sales tax holidays over the course of a year. I think there were 2 states that had more than 3. And the types of transactions that count towards sales tax holidays are not just back to school kinds of stuff, but disaster preparedness, guns, and Energy Star consumption, which I would imagine other kinds of benefits and subsidies exist for as well. So it seems kind of haphazard what states choose to give this preferential treatment toward, and the vast body of research on this basically shows that it does nothing to increase overall consumption. It just causes people to pull forward purchases that they would have done otherwise a couple of months later. But all is not lost. I thought a terrific alternative title for your paper could be the quote on page 21, "The new economy is not necessarily gloom and doom for the sales tax." So there are a number of things that are, the first 3 culprits on the right are sort of the original sin, the original construction of the sales tax that are vestiges that have lasted up until the present. So the fact that it applies too narrow in the extent that it excludes services, and it's also too broad to the extent that it captures too many business-to-business transactions and leads to pyramiding or excessive tax rates at on the final consumer. And also this exclusive basis, which the paper says, perhaps appeals to, it should be equivalent whether you see the sales tax included in the purchase price or it's tacked on at the end. And there's research showing that consumers don't really differentiate between this. They're not really that aware of the sales tax, even when it's included in the purchase price. But the paper sort of says that perhaps to politicians it's important that it be seen as added after the fact and not included in prices. Longstanding uncertainty in terms of remote and informal sales. So before the internet, it was catalog sales, Sears, that sort of thing. And then there's this new uncertainty, zappers and phantomware, which is something that I didn't know about and I was intrigued to learn about. But for each of these bads, you can see an offsetting good. So there are a number of jurisdictions that have experimented with adding services to the sales tax, including DC, the so-called yoga tax or tax on health, which people in this room have been responsible for. Wayfair actually clears up some ambiguity about taxing sellers from out of state. And then technology can also be seen as a friend in terms of tracking transactions that are cashless. So there are good and bad things to keep in mind. So overall, this is just a magisterial treatment of this topic. I highly recommend the paper. I just had a couple of questions. So first, in terms of the importance of the sales tax, the paper presents means, and I thought looking at medians would be important given that you can have extreme values that are skewing averages. And certainly, so there's variation is the bottom line. There's a 5-fold difference between the state that collects the lowest sales taxes as a share of total revenue and the highest, Vermont and Texas. And so here, just the difference between mean and median show you that, so I would emphasize the variation there. And then this is the same figure that appears in the paper and that Sharon showed you, but you can see that, and Kim and I have a paper where we talk about a paper that was written during the Great Depression that says, oh my God, the sky is falling, there's a real estate bust, revenue is going through the floor, and the punchline is that's actually the Great Depression, not the Great Recession. So the paper talks about what happened in this period from 1927 to 1932, but you can see that the property tax decline, states used to collect property taxes, that actually started prior to the Great Depression. So what happened, one argument is that states found a revenue source that they liked better, or they found things that they were better at doing. They were better at collecting taxes on sales and and specifically motor vehicle sales and registrations, other kinds of transactions. So this is work from John Wallace that basically shows that property taxes are declining thing in this period in the early 20th century, but you see motor fuel sales and motor vehicle license fees going way up for states. So basically, states found something that they were better at doing. Local governments could continue to collect property taxes, in particular because people who lived there saw the value of property taxes for providing services, whereas when you're a state, it's kind of harder to make that argument. You're collecting property taxes, but then spending them in other jurisdictions. So difference in importance of the sales tax by state. And then also in terms of the, I forgot how I phrased that, equity. Right, what about equity? So the textbook concern with exemptions for food purchases is that it's this unlevel playing field thing again, where why is a marshmallow considered food and a sandwich isn't, or something like that. So, but the issue with state taxes generally is that these are seen as regressive systems, in part because of the legacy of the sales tax, and the degree to which they're not regressive, they don't hit low-income people disproportionately, has a lot to do with these exemptions for things like food, prescription drugs, clothing, and that sort of thing. So this is a paper actually from the Hutchins Center that summarizes a paper by Byron Lutz and co-authors at the Fed that shows that for the most part, federal income or federal taxes generally offset income inequality, and state taxes offset the positive effects of federal taxes on income inequality. And a lot of that offset has to do with these exemptions for food and other things. So that's a very good paper that I would recommend to you. So there's some implicit, I'm running out of time so quickly, there's implicit normative statements in the paper about the value of taxing consumption, and I would just pose questions about, again, the low end of the income distribution and people at the top end of the age distribution and the role of consumption in their life, and whether this is really a measure of ability to pay or just the fact that they're forced to consume a lot out of their household budgets. Sure, we could get rid of exemptions for food and instead give people a credit, but there's something like 5 states that do that, and there used to be more, and it's not constant over time, so that doesn't seem like a very stable solution. Data adjustments, I gotta say something about this. So John is famous for doing these adjustments to census data, and I was with him once at the Census Bureau where he encouraged them actually to not fix what he views as mistakes in classification, because then he couldn't do his adjustments anymore. And they sort of nodded and said, yes, we respect your judgment, and we understand why you're making the adjustments we do, and we can't really help what we're doing. But I was thinking, this is terrible for transparency and replication, and I just have no idea how to recreate the wonderful work that you guys have done. So please publish some kind of a data crosswalk rather than forcing us to kind of back things out and ask, what would John Mikesell do? Let me just say one more thing about Wayfair. So obviously there's a new sheriff in town. There are new rules. A lot has to do with how it's enforced, and there's questions about should transactions be taxed at the buyer versus the seller level. I saw Representative Goodlatte had a proposal that the business actually collects the tax, but then from the consumer, but then pays the rate at which in the jurisdiction where the business does its work. So there are various proposals about how this is actually going to be done, what the de minimis rule is for excluding certain firms, how to treat these facilitators, and whether a lot of it depends on what states do. If they overreach and try to apply the tax retroactively, then Congress will step in. So the bottom line is that we have this wonderful exogenous event in Wayfair. States are about to make a lot of decisions about their sales tax. There are a lot of questions about how to act in the new economy, but I think the point of the paper is that there are a lot of messes from the old economy. It would be nice if they use this as an opportunity to clean those up. So thank you very much.
Open it up to the floor for comments. Way in the back. And who has there you go, Anna. Remember, identify yourself, please, before you ask the question.
Hi, I'm Bill Glasgow from the Volcker Alliance. It's just a comment on the study, which is really terrific. One thing we found in our research on states is that it may take a lot of digging to discover what sales tax exemptions are given out. There's about 25% of the states publish no tax expenditure budgets at all, and a fair number of other ones publish very spotty ones. So it's quite difficult to find out. And furthermore, the tax, sales tax and other tax expenditure, holidays, exemptions, credits, what have you, are not routinely reviewed by legislatures. So they once enacted, they go on forever. In New Jersey, toilet paper and paper goods, household paper goods are exempted, have been exempted from sales tax for years and years. It costs the state a couple $100 million a year in foregone revenue, but nobody ever stops to look at the value of that, and that's something that's really important. And I hope your paper will spark that kind of debate.
Thank you for that comment. I think the tax expenditures goes across the board on all taxes, not just the retail sales tax. What I do know, at least from the state of Washington, is they do have an extensive catalog of what is taxable and what is tax exempt. So they know the categories, but they don't necessarily know what the revenue loss is on that end.
Hi, Terry Finn with Stern Brothers, and we're in the public finance business, and we are seeing a lot of special assessment districts, TIF, TDD, CID, and so on. So they have sales tax within those taxing districts that are over and above the sales tax that I think you're referring to. Do you take that into account in any way, shape, or form, or how might that affect your data?
Not at all. That would be considered a local option sales tax. So what we've presented here is only the state tax rate and the state tax, how much the state is collecting. The state does collect on behalf of those local jurisdictions. The one thing that's not clear that is important to remember is that at least from the decision on South Dakota v. Wayfair, it only just addresses the state tax rate and collection of that. So unless you're part of this sales tax streamlined project, you're not going to be able to force vendors to collect the local option of that.
Don Boyd, Rockefeller College. Could you address a little bit more the question of the facilitators? And I'm thinking in three kinds, or maybe it's two kinds. One is Amazon with their affiliated sellers, and the other is the Airbnb and maybe Uber kind, where they're doing similar things. Do you think Wayfair will allow states to force the facilitators to collect, I guess, and how significant is that?
So there's a difference. So marketplace facilitators would be the Amazon, if you've been to Etsy to buy small gifts that are made by individual merchants, that's a marketplace facilitator. It's a platform that brings small businesses and does the marketing and manages the sales and able to collect the payment. The sharing economy is not a marketplace facilitator, because if you think about Airbnb or Uber, you're using the taxi in that state, right? Whereas Etsy, the person who's selling you the product is not within that state. So forcing a marketplace facilitator to comply with the sales tax laws may be challenged in court. But the Uber left Airbnb, the providers within the state, so the physical presence rule is already satisfied. The question is, one, do you have a tax on that equivalent service? So if you have a tax on hotel, then you should be able to have a tax on Airbnb services. But if you don't have a tax on taxis, then you cannot impose a tax on Uber or Lyft. Then secondly, are they willing to collect that tax? So even if you have the tax, are they willing to collect that tax? And Airbnb only does that in about 20 states. And Uber Lyft, it's a haphazard in the collection. And there are other platforms that are similar.
Do you think the states could require the Airbnb, Uber to collect?
They'll face challenge. I'm sure they'll face challenges in court. even though the sharing economy platform would be a very easy fix for the collection, rather than asking individual drivers or people who own their homes to submit the tax itself.
My name is Lajuni, and I'm from Smp Global Ratings. I have more of a comment than a question, and it's the fact that for some states or some taxing agencies, sales tax has been used not just for revenue generation, but for kind of shaping behaviors. So you see where you have cigarette taxes, you have sugar taxes, and so sometimes what is taxed versus what is not being taxed is not really driven by the ability to collect revenue, but to shape some behaviors.
So that those two imperatives that you mentioned came to a head in Philadelphia. My colleague Richard Oxter wrote a blog about how the mayor of Philadelphia was surprised when the sugar-sweetened beverage tax was not sufficient to cover part of the education budget. But that wasn't the point of the tax in the first place. It was to shape people's consumption of those beverages, although other colleagues at the Tax Policy Center have written about how if you really want to discourage sugar consumption, it should be based on sugar and not the volume of the drink that somebody just bought, because, you know, a Coke has more than an orange juice or something like that. So I agree with you completely. You can have these objectives go in conflict with one another. I wanted to also just recognize what the gentleman said about local sales taxes, that is, I think, even though that wasn't the subject of the paper, obviously a lot of the criticisms here about pyramiding and about administrative ease definitely apply when you start layering those taxes on top of the state sales taxes.
Yeah, and a quick comment on the sugar tax. That would be a selective tax and not a retail sales tax. So we're really just looking at the most traditional form of a retail sales tax. Anything that would be considered selective, we didn't study in here. Thank you.
So Tracy, you brought up local sales tax, and one of the things I was wondering is, what's the political economy between the local governments and the state government? And one of the things you always hear from a federal perspective is that, oh, you could never get a VAT here because the states view kind of consumption taxes in state localities. What is the political economy between those two? Is there, like, have things shifted to localities, or have local sales taxes declined too, or do you know?
Well, I think it's predominantly a state tax, in part because the localities have this comparative advantage when it comes to property taxes. But I think you do see the same types of competition. It's just not as clear cut as it is between the federal government and local governments. But the paper does talk about similarities between the retail sales tax and a VAT, which I wondered for the same reason whether that was really the kind of path that you want to go down. I can see how it would appeal to people who are not familiar with the United States and might want to think about how their country's consumption tax compares to ours, but I do see it as sort of a different beast for that reason.
Before I get to the question, Andy Glassberg, University of Missouri, St. Louis, but now a resident of Maine. And so on this last point, at least just to start with that, I think a lot of the issue between local and state depends on the extent to which there are localities that would have the ability to export sales tax. Very striking in Maine. Portland really would like to be able to tax all those tourists who are not Maine residents. Now, the question I intended to ask before that came up, and it goes to the first paper as much, maybe even more, than to this one. And that is that it does seem to me that there's some ambiguity about whether we're talking about how the states act and the impact on states, where we routinely treat them all the same. We've got an N of 50, we know what it is, and the impact on the nation, which is really quite different. Florida is more important in terms of the national economy than is, choose your alternative. I'm not going to do that. We could easily enough aggregate the data that is presented typically where every state counts the same and weight it, whether we weighted it by economic variables or we weighted it by population variables. And I'm curious about what impact it would have on any of these analyses if we did more of that. I'll make one further argument about why we should do it. Theoretically, it's always been true. But given the way the politics of the country is dividing, in part the rural collapse of Democrats, the distinction among the states starts, to me, to start looking more like the classic distinction we've seen among counties. Nobody in his right mind would any longer describe the politics of a state by counting up how many counties wanted to do this and how many counties wanted to do that. And I'm wondering whether, I don't want to push the point too far, we're having a bit of that now at the national level, which would increase the importance of you to, not to the exclusion of counting all states, but looking also at whether it's the economy or population size.
So I think in general, when I think about this, whether I wait or not depends on whether I think my unit is a state or whether I think my unit is a person, right, in terms of population and what goes on. So when we're thinking about things where states are acting and you're actually doing it on a per capita basis, then the states are individually acting and they're sort of the actors. I think there is some legitimacy to see how this all plays out. With the political economy, you get into some trouble if you try and underweight certain states just because of the Senate, where the states that might be more powerful are not the states that you actually think are important, but they are politically just because they still get 2 senators. I've done some of this. I've done a lot of work on immigration and how those policies work, and sort of when we're thinking about schools and costs, where it makes sense to sort of think of it on, like, where you weight things based on the individual, how many people live in a state or how much they're spending. In some ways, you can look at the aggregate dollar amount spent and do some of this, but in part, I think it depends on what question you're asking and who the actor is.
So for my mean versus median figure, I was surprised actually there wasn't more of a gap between those 2 lines. But then I was thinking about it. You've got 50 observations, and we are implicitly treating them all the same. I think if we would have population weighted that figure, we would have seen a much bigger difference between the mean and the median, because it's the big states that are really driving the reliance on income taxes as opposed to sales taxes in particular.
That's not true.
Really?
Texas and Florida, no income tax.
No, that's what I'm saying. Is the states that are relying more on the income tax as opposed to the sales tax are the states that have all the people, right?
No, but I'm saying that
California.
Texas and Florida
We're-
have no income tax.
Right, we're saying
So
this. We're saying the same thing from opposite, and I'm saying that the states that rely on income taxes instead of sales taxes are where the people live,
and
right?
I'm saying that there are states that are more reliant
Oh, I see. Oh, we're not saying the same thing. Great. Okay. Okay. So that's interesting. So I wonder if okay. So then there's like share of the economy. There's all kinds of ways that you could think about
Right,
weighting
so New
it.
York and
Yeah.
California have a lot of people, but so do Texas
Yeah.
and Florida.
Can I, one more thing about the local and the political economy thing, though, is that you also have this administrative bargain, right, where states are collecting local sales taxes.
Everywhere?
And then,
Is that how it works?
No, but in some cases they are. So in fact, in California, you've got both. There's a state add-on, and then there's the local version that they can do themselves. So, but that does sort of take some of the sting out of the base competition out.
We have room for one more question. Anybody back there? Oh, we have 2 questions. We may. Stay back.
Eric Kim with Fitch Ratings. Thank you for the paper and the discussion. It's been really interesting. Has there been any good research on the question of the aging population and what effect that might have on the retail sales tax, and any sense of whether that has a more significant effect than some of the factors we've been talking about?
That would be a great question for John. I don't think there has been. My sense is for the aging, if our demographics are changing in that manner, what we're seeing is higher spending, particularly on healthcare, and that is unlikely to be taxed. So we wouldn't necessarily see any effect, even if we were to adopt that in terms of a policy.
Well, you might see declining retail sales tax as more income is shifted towards non-tax services like healthcare, right? So it might actually just make everything you've seen,
The trend
the trend even and steeper. One last question's over there.
Thank you so much. My name is Dorma, and I'm just a concerned citizen. I have some journalistic training, so I try to educate myself and also educate as many as people that are just ordinary and very honest and who had worked hard all their lives, you know? And now there are so many changes and high level, this and that, tax evasion, you know, ways and means of doing things to avoid and buy stuff and which are legal, that sort of stuff. So if it's okay for you guys to share, and I bet you guys might have thought about that. What if there's some kind of earthquake or some kind of anarchy or some kind of world changes, which is, you know, the Bitcoins and whatever these are talking about. I was thinking about all those things all these years. And that why, you know, if you're doing that, why can't we do that so that we'll escape all these nitty-gritty stuff that are so unfair and they can impose on us, you know, that sort of stuff. So do you guys have any advice, or have you ever come across any research paper, that sort of stuff? I do kind of, as a contribution, do write down a few ideas in there, but nothing, to be honest. And I think I kind of give up now that it'll never become a full paper or something to be published and that sort of stuff. But
So-
absolutely could be like some kind of help, or
Great.
so you guys can
So-
think about.
all right, let Tracy answer.
Thank you
Can I-
so much.
Yeah, if I could say something about tax exporting, this idea that the sort of what you're taxing matters a lot. Right. So for things like tax evasion, for example, it matters a lot sort of how you define the base of things that states could tax. It does make a big difference what you think of as the ideal or what's potentially possible. And that was the gist of the John Mikesell thing, that you think about retail sales, for example, that happen in a state, then you're getting all the tourists. Whereas you think about consumption, that consumption could be happening, you know, especially for things like people who are migrating, who are snowbirds from Maine to Florida. So thinking about the ideal and how you're going to actually approximate that ideal matters a lot for both measurement and sort of these normative questions.
Okay, great. You get the last word. Please join me in thanking our panelists for a great paper and discussion.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.